Welcome to Investing Through Mutual Funds. This module begins the rebuild of the fund industry by connecting the durable ideas in Pauzen and Hamachir's second edition with the fund market students encounter today. We will examine why pooled investing became so important, what benefits and trade-offs the structure creates, how the industry grew from a Boston experiment into a $45 trillion system, and why regulation, governance, and trust are inseparable from the product. The slides are intentionally visual. The speaker notes carry the full explanation and can also serve as the narration, transcript, and accessibility text. Many students already own mutual funds before they ever take an investments course. A workplace plan may place contributions in a target date fund. An IRA may hold an index mutual fund. A brokerage account may contain an ETF, and a 529 account may use an age-based portfolio built from several funds. The fund is the operating layer between the investor and the underlying stocks, bonds, or short-term instruments. That makes the first analytical question broader than the ticker symbol. We need to ask what role the fund is supposed to play, how the wrapper works, and whether its costs, risks, and governance fit the investor's objective. Many people become fund investors the same way they become owners of a smoke detector, automatically and without reading the manual. This module has 5 outcomes. First, you should be able to explain the practical value created by pooling, including diversification, divisibility, shared administration, and access to professional processes. Second, you should separate those benefits from the risks and costs that still belong to the investor. Third, you should be able to interpret current evidence about the industry's scale, household ownership, and the growing role of index funds. Fourth, you should recognize the historical turning points that shape today's market. Finally, you should be able to map the laws, regulators, fund boards, and industry organizations that make a mutual fund more than a portfolio of securities. The chapter is organized around 5 questions. We begin with the economic reason funds exist. Then we ask what the structure does not solve, including market risk, fees, taxes, and conflicts. Next, we measure the size and reach of the modern fund system. We then use history to explain why today's products and rules look the way they do. Finally, we examine the institutions that support trust. The sequence matters. Regulation makes more sense after we understand the conflicts it is designed to manage, and product comparisons make more sense after we separate the fund's investment strategy from its legal and operating structure. A mutual fund combines 2 ideas. Economically, it is a portfolio owned collectively by shareholders. Operationally, it is an organization that issues shares, calculates net asset value, maintains records, distributes income, and contracts with advisors and service providers. Investors contribute cash and receive fund shares. The fund then owns the underlying securities. Dividends, interest, realized gains, and changes in market value eventually flow back to shareholders through distributions or changes in NAV. This distinction matters because a fund can hold excellent securities and still provide a poor investor experience if its costs, operations, disclosure, or governance are weak. The fund portfolio sits inside a larger ecosystem. A board oversees the fund and its contracts. The investment advisor researches securities and implements policy. A custodian safeguards assets. Fund accountants and administrators maintain the books and calculate NAV. The transfer agent maintains shareholder accounts and processes transactions. Distributors, retirement plans, broker-dealers, and platforms connect the fund to investors. Some functions are performed inside the management company, while others are outsourced. Students should learn to see the fund as a coordinated operating system. A failure in valuation, cybersecurity, record-keeping, or distribution can matter even when the portfolio manager made sound investment decisions. Pooling creates value because many investors can share the fixed costs of a portfolio and its operating system. A single fund share can provide exposure to hundreds or thousands of securities. Small contributions can access a portfolio that would be difficult to reproduce directly. The fund handles record keeping, valuation, distributions, statements, and tax reporting. Professional management adds a repeatable process for research, trading, and risk control. Scale can also reduce some custody and transaction costs. None of these benefits is free, and scale can create its own problems, but the core economic insight is shared infrastructure. The fund industrializes tasks that would be inefficient for many individuals to perform alone. Diversification is one of the strongest reasons to use a fund. A concentrated investor may depend heavily on the success of one company, industry, issuer, or security. A diversified fund spreads exposure across many holdings, so company-specific surprises can offset one another. That can reduce uncompensated risk and make the portfolio more stable relative to a single position. But diversification is not the same as safety. A broad equity fund can still decline sharply when the entire market falls. A bond fund can still lose value when rates rise or credit spreads widen. The correct claim is narrower. Diversification reduces dependence on individual holdings. It does not remove the economic risk shared across the portfolio. Divisibility changes access. An investor with a modest contribution does not need enough cash to purchase every security in the portfolio. The investor buys a fractional interest in the fund, and the fund allocates capital across the full portfolio. This feature supports payroll deductions, automatic monthly investing, dividend reinvestment, and target date portfolios that rebalance without requiring the participant to trade individual securities. Divisibility is especially important in retirement plans, where contributions arrive every pay period and where simplicity can improve participation. The investor still owns a risky asset, but the operational barrier to building and maintaining a diversified position is much lower. Professional management should be understood as a process rather than a guarantee. A fund begins with a mandate and benchmark. Analysts and portfolio managers research securities, estimate risk, construct positions, and decide how much liquidity to hold. Traders implement the decisions, while operations and compliance teams monitor the portfolio and its limits. This institutional process can improve consistency, access, and execution. It can also fail through poor judgment, weak incentives, excessive costs, capacity constraints, or style drift. The right question is not simply whether the manager is a professional. It is whether the process is coherent, repeatable, appropriately governed, and likely to deliver the intended exposure after costs. Fund administration is easy to overlook because successful operations are quiet. Every business day, the fund must value securities, accrue income and expenses, reconcile cash and positions, process shareholder transactions, maintain account records, and produce disclosures and tax information. These tasks create convenience for investors and confidence in the fund's reported value. They also introduce operational risk. A pricing error, stale security value, failed trade, data breach, or record-keeping problem can affect many shareholders at once. One reason the industry has become so large is that these processes are standardized and scalable. One reason oversight remains essential is that the same scale can magnify mistakes. A mutual fund is not simply a list of advantages. Pooling can improve diversification, convenience, professional process, liquidity, and disclosure. At the same time, the investor still bears the portfolio's market, credit, interest rate, and liquidity risks. The fund adds management risk, expenses, trading costs, taxes, and possible conflicts in distribution or affiliated services. It also does not protect the investor from poor behavior. An investor can still chase last year's winner or sell during a market decline. A good course should present the structure as a trade. The fund replaces many individual decisions with a governed system, but the quality and fit of that system still must be evaluated. This slide sharpens the diversification claim. Suppose one company in a diversified portfolio falls 60% because of a product failure or accounting scandal. The loss matters, but the effect on the whole fund may be limited. Now suppose investors revise their expectations for interest rates, growth, or risk across the market. Many holdings may decline together. In that situation, diversification across companies does not eliminate the common exposure. Correlations can also rise during stress, reducing the protection investors expected. Students should therefore ask two separate questions. How diversified is the portfolio across holdings, and what broad economic risks remain shared across those holdings? A fund is not automatically superior to owning securities directly. A direct portfolio provides control over holdings, tax lots, and trading decisions, and it does not charge a fund expense ratio. But the investor must research securities, maintain diversification, rebalance, and keep records. A fund packages those tasks, which can be especially valuable for small contributions, retirement plans, or investors who want a systematic process. The comparison must include the total system. A low expense ratio may not compensate for poor fit, avoidable trading costs, tax inefficiency, or behavioral friction. Conversely, a slightly more expensive fund may be useful if it reliably automates a portfolio decision the investor would otherwise neglect. The modern fund industry is enormous. At year-end 2025, U.S. registered investment companies held about $45.1 trillion. Mutual funds accounted for roughly $31.4 trillion, and ETFs held about $13.4 trillion. Traditional closed-end funds and unit investment trusts were much smaller. The scale matters for two reasons. First, funds are not a niche product. They are core infrastructure for household saving and capital markets. Second, seemingly small design choices become economically large when applied across trillions of dollars. A few basis points of cost, a change in tax efficiency, or a liquidity problem can transfer billions between shareholders, intermediaries, and markets. Mutual funds are woven into household finance. In 2025, an estimated 72.7 million U.S. households owned mutual funds, representing about 123.2 million individual investors. That is roughly 54% of households. Ownership is closely connected to retirement saving. Many people meet their first mutual fund through payroll deductions rather than through a brokerage trading screen. This helps explain why administration, disclosure, target date design, and plan governance are central industry issues. It also changes how we should teach the subject. The typical shareholder may be a long-term saver making automatic contributions, not a professional selecting a standalone fund for a tactical trade. The fund market has changed structurally since the textbook's 2015 edition. By May 2026, index mutual funds and ETFs held about $21.8 trillion, or 53.8% of combined long-term fund assets. Active funds held about $18.7 trillion. At year-end 2025, the index share was 52%, up from 19% in 2010. This does not mean active management disappeared. Active funds remain enormous, and the balance differs across equity, bond, and hybrid categories. The important teaching point is that index investing is no longer a specialized alternative. It is now part of the industry's center, shaping fees, distribution, product design, and debates about market ownership. The fund industry's history is a sequence of innovation and repair. The Massachusetts Investors Trust opened in 1924 and established the redeemable open-end model. The Investment Company Act of 1940 created a durable regulatory framework after the crash and depression exposed weaknesses in earlier investment trusts. Retail indexing arrived in 1976, and exchange-traded funds added intraday trading in 1993. The late trading and market timing scandal of 2003 revealed conflicts and failures in order processing and equal treatment. More recently, the industry has adapted to T+1 settlement, rapid ETF growth, digital distribution, and an index majority. History matters because every operating rule has a problem it was designed to solve. The first U.S. open-end mutual fund is usually identified as Massachusetts Investors Trust, which opened in Boston in March 1924. Its innovations sound ordinary today. A simplified capital structure, a continuous offering of shares, the ability to redeem shares rather than wait for the trust to dissolve, and clearly stated investment policies. That is a useful historical lesson. Successful financial infrastructure becomes invisible because later users inherit the design as normal. The open-end structure made the product more flexible and scalable for households, but it also created daily obligations to value the portfolio, process orders fairly, and maintain liquidity for redemptions. The innovation and the operating challenge arrive together. When Vanguard launched the first index fund for individual investors in August 1976, the offering raised only a little more than $11 million. The sponsor had hoped for far more, and John Bogle later called the launch an abject failure. Critics described indexing as a cop-out and a fad. The story is memorable because it reverses the usual marketing script. The product did not promise superior security selection. It promised broad exposure, discipline, and low cost. That proposition eventually became a default approach for millions of investors. The lesson is not that every unpopular launch will succeed, it is that a product can win by changing the basis of competition, from prediction to implementation efficiency. That history contains one of finance's better punchlines. The product mocked for delivering the average market return later helped move trillions of dollars into index funds. The 2003 mutual fund scandal is an operating lesson disguised as a trading story. Late trading allowed favored customers to submit orders after the market close, but receive the NAV calculated as if the order had arrived before 4 o'clock. Market timers also exploited stale prices or received exceptions that ordinary shareholders did not receive. The gains did not appear from nowhere. They diluted the interests of long-term investors. The SEC brought enforcement actions and adopted reforms related to compliance, disclosure, and trading controls. The durable principle is equal treatment. A fund's fiduciary duty is expressed not only through portfolio selection, but also through timestamps, pricing rules, data access, and the design of operational exceptions. Mutual funds are trust products, even when we use the word trust informally. Shareholders transfer cash and delegate investment discretion to people they may never meet. They rely on the fund to safeguard assets, calculate a fair price, follow the stated mandate, control conflicts, and treat orders consistently. That reliance is economically valuable because it reduces the amount of verification each investor must perform. When trust fails, the cost rises. Investors demand more disclosure, intermediaries add controls, regulators intervene, litigation increases, and the fund may lose assets. Governance, therefore, is not an administrative afterthought. It is part of the product's value proposition, just as important as the portfolio's expected return. The legal framework is layered because a mutual fund performs several functions at once. The Securities Act of 1933 and Exchange Act of 1934 govern offering disclosure, anti-fraud protections, broker-dealers, and market activity. The Investment Company Act of 1940 regulates the fund's structure and operations, including governance, custody, leverage, and conflicts. The Investment Advisors Act regulates the advisor. When funds are held in private retirement plans, ERISA adds fiduciary and plan administration standards. The Internal Revenue Code governs regulated investment company status and the pass-through treatment of income and gains. Students do not need to memorize every section. They should understand which problem each layer is meant to address. Oversight is distributed. The SEC regulates registered funds and investment advisors and enforces federal securities laws. FINRA does not regulate the mutual fund itself, but it regulates the broker-dealers and representatives that sell fund shares, including advertising, sales practices, and certain compensation issues. The Department of Labor's Employee Benefit Security Administration oversees ERISA-covered retirement plans. The IRS administers tax rules and reporting. Fund boards provide an internal governance layer, while state regulators and insurance authorities may matter for particular products or distribution channels. This map explains why a single investor complaint can involve several institutions. It also shows why coordination and clear accountability are essential. A mutual fund often looks like a product offered by a management company, but legally the fund is a separate entity with its own board. The board does not manage the portfolio security by security. Its role is oversight. Directors approve and monitor key contracts, review fees and performance, assess risk and compliance, and represent the fund when the advisor or an affiliate has a conflict. This is important because the management company earns revenue from the fund while shareholders bear the costs. Independent directors cannot eliminate every conflict, but they create a governance mechanism with authority separate from the advisor's commercial interests. The useful question is always, who can say no, and on whose behalf? Investor protection works as a stack. Disclosure gives investors information about objectives, risks, fees, holdings, and performance. Custody, reconciliation, valuation, and liquidity controls protect the assets and the daily price. The board creates governance over contracts and conflicts. Compliance programs, audits, and a chief compliance officer test whether the rules are actually being followed. Examinations, enforcement, restitution, and litigation provide consequences and remediation. No layer is perfect. Disclosure cannot fix stolen assets, and an audit cannot make an unsuitable strategy appropriate. The layers are designed to overlap so that a weakness in one control is more likely to be detected by another. The second edition was published in 2015, so the course must distinguish durable concepts from dated market context. ETF assets reached about $13.4 trillion by year-end 2025, and active ETFs became a meaningful category. Index funds became the majority of long-term fund assets. Average expense ratios continued to fall. The U.S. market moved to T+1 settlement in 2024, which compressed operational timelines. Mobile access and outsourced data systems increased cybersecurity and concentration risks. Product menus expanded to active, buffered, options-based, alternative, and model portfolio strategies. The modernization rule is simple. Keep the chapter's operating logic, but refresh its data, examples, regulations, and product landscape. The modern product menu is multidimensional. An investor can hold broad equity exposure in a mutual fund, ETF, target date fund, collective trust, or advisor model. The portfolio may be index, active, or rules-based. The account may be a 401k, IRA, taxable brokerage account, or insurance product. These layers affect pricing, taxes, liquidity, disclosure, costs, and investor behavior. Therefore, a ticker is not a complete classification. Students should identify 4 elements: what the portfolio owns, how shares are issued or traded, how investment decisions are made, and where the investor holds the product. This framework prevents comparisons that attribute a strategy difference to the wrapper or an account rule to the fund itself. A practical fund review begins with fit. What goal should the fund serve? What is the time horizon? Which account holds it? And what investor behavior must the design support? Next, identify the actual exposure, including concentration, duration, credit, leverage, and underlying holdings. Examine the structure, NAV or market price, liquidity, tax mechanics, and redemption process. Add the total cost stack, not just the expense ratio. Review governance, the advisor, the board, and important conflicts. Finally, evaluate evidence using the correct benchmark, risk measures, persistence, and capacity. A fund is not good in the abstract. It is suitable or unsuitable for a specific role. Apply the framework to a long-term retirement saver making monthly payroll contributions. Fund A is a low-cost index mutual fund with automatic investing. Fund B is an ETF tracking similar exposure with a slightly lower expense ratio, but an intraday spread and more investor responsibility. Fund C costs more, but provides a global allocation and automatic rebalancing. For this investor, Fund C may create the best total system because it solves the allocation and maintenance problems the investor does not want to manage. The answer could change for a large taxable lump sum, a hands-on investor, or a different desired allocation. A few basis points matter, but so does a process the investor can actually follow. Pause and answer the 4 questions. First, which benefit primarily reduces dependence on one issuer? Second, which organization regulates the broker-dealers and representatives that sell mutual funds? Third, what principle was violated when favored traders submitted orders after the market closed but received the earlier NAV? Fourth, what should come first in fund selection? The answers are 1. A. Diversification. 2. A. FINRA. 3. A. Equal pricing treatment. 4. B. The investor's objective and the role the fund is supposed to play. Carry forward 6 ideas. Pooling makes diversification, fractional ownership, and administration accessible. The structure does not eliminate market risk, management risk, costs, taxes, conflicts, or poor investor behavior. The industry's scale makes funds important household and market infrastructure. History explains why today's rules emphasize redeemability, custody, pricing, governance, and equal treatment. Trust is designed through overlapping layers of boards, controls, disclosure, regulators, and enforcement. Finally, fit comes first. A fund should be judged by the job it must perform for a specific investor after total cost. The next module moves inside the structure to examine shares, NAV, taxes, service providers, and ethical standards. By the end of the course, a prospectus may not become beach reading, but it should stop looking like a foreign language. You have completed the introductory module. The next chapter will move inside the mutual fund to explain how investors buy and redeem shares, how NAV is calculated, why the fund is sometimes described as a virtual corporation, how pass-through tax treatment works, and where ethical standards enter daily operations. Before publishing this deck, review the examples in your own teaching voice, generate one narration file per slide, and listen for pronunciation and pacing. The data slides should be refreshed before each new academic year. Because the speaker notes contain the full script, they can also support the LMS transcript, captions, and accessibility review.